Hey, what's up, everybody? I have another great Robnostication for you coming right this moment. And today I want to talk about, do we have reason for optimism or are we dealing in Hope-ium? That's right. We don't want to be dealing in Hope-ium, but is there reason for optimism? Coach Hau is here to help you with your real estate decisions, whether it's an opportunity ahead or decisions you need to make right now. Now you know how. On the other side, we're going to get into it. Whole lot coming just for you. Hey, what's up, everybody? Welcome to another Robnostication. This one is for January 2023. Can't even believe it. We're already going into February 2023. So that's what we're going to be talking about. I've got a bunch that's on, the table here. We have some reasons for potential optimism going forward. There were some things that happened that I want to speak about. I want to make sure we're not dealing in what I am calling Hope-ium.
It's beautiful, isn't it? Just like I knew it would be.
That is where we get too hopeful about what we think is going to happen, and then, other stuff happens. So let's get into it. Right now, I want to Robnosticate on the interest rate. For a moment there, I was really thinking we would see sort of a pivot from the Fed in going into February when they make their next rate change, which is going to be an upward one. I was going to come on here and say, I think it's going to be 0.25%. This could be where we're dealing in Hope-ium, and I don't want to make that call just yet because they're actually signaling it. There are a number of different people signaling that the rate will be just 0.25%, which would be our best indicator for a Fed pivot. But because I have trust issues with the Fed, I'm not willing to say that just yet. I think they could very quickly reverse and in March go ahead and bump it back up, bump up to 50 basis points. Here's my reasoning on all of this. Rates are obviously very volatile, especially in the mortgage business right now. In the mortgage side of things, they're very volatile. They've been remaining relatively low compared to where they spiked to. But, the changes in environment, the bond market, these things could change the interest rates very quickly. And, with the rate changes ahead and not knowing for sure what the Fed is going to do, this keeps things volatile. So we're going to have to see what the Fed does. It's either going to be 25 or 50 basis points. There is some information I'm going to go over with you as I go along as to why I am concerned that they could stay strong on the 50 basis points and not go with 25, even with other information I'm about to tell you that is positive. Now, I'll go into inventory. This is what I got wrong in my last Robnostication. Inventory actually went down from December to January. And that was a little bit of a surprise to me because, we've had a very slow market. But what's happening is that nobody's putting their stuff on the market. Everybody said, we're going to take the holidays off. That was a little bit of a surprise, but looking back on it, it shouldn't have been that surprising to me. I do believe we're going to see more inventory. And what my concern is here is that we're actually going to see really large spikes in inventory in the coming months because I still don't see the buyer activity that are going to suck up these properties unless we start getting some really well-priced stuff that fits with the interest rate that people are getting and sellers are willing to make deals. I just don't see that. First of all, maybe a lot of them just don't want to come on market. Look, if you want to wait, I think that what I have to tell you is maybe a little bit of choppy waters ahead where you're going to have to navigate for a while. If you want to wait, it's probably a year plus before we start looking a little better. So we'll see if those buyers are waiting till spring like they usually do. I'm pretty sure sellers are, but the question will be is if the buyers are there to take up that inventory. I don't see them coming out in droves, so we'll see if I get that right over time. Volume of sales, it was way down. Okay, volume, this is another indicator for me that, inventory didn't go up, but volume was way down. It was the lowest since 2010. Okay, what happened in 2010? Well, that was like the getting near the height of the bottom of the Great Recession that we had back then. I remember very well because I've been in the business since late 2009. So I was absolutely active. It was an odd time because, you know, you look back now and anything you could touch, you should have bought when it comes to real estate. Looking back, really easy to say that. But yet, primary residence buyers were really scared. They were really fearful that they would, that the market was still destabilized. And technically it took till the end of 2011 and the beginning of 2012 to start going back up. Nonetheless, I think many people would choose to buy at that time. Why not? Because it just absolutely went way up, right? Even if you didn't buy at the very bottom, which is something I always caution people. Be careful about trying to hit that perfect mark. But here's the deal. Investors were buying. I was working with a lot of investors at that time, and I was definitely working with some primary residence buyers, the parents that were helping buy their children a property because they knew it was a good deal and a good time. They could use some cash to purchase a $100,000 property that later turned into $300,000, $350,000. But the investors were buying because the investors are the ones that are going to put the fear aside first. It's odd, but people that are buying their house for a longer period of time, which should be thinking more stable, that should be a more stable outlook for them, are more concerned and more fearful and more going to kick the tires on properties for a longer period of time until they finally make a move when they're fearful. Think about that now. Is that taking place now? Are we seeing a lot of fear in the market? I think we are. It was definitely brought up to me by a friend of mine, David Williams. I'll actually mention him here. If you've known me for a while, you've probably heard me mention him before. Smart guy. He's in the markets. He's in the commodities markets, and he's a forecaster for stocks, mostly commodities. He recently kind of just put the word fear into my head, and it was like going back to that time. And then another guy that I follow mentioned this as well, and it's like, yeah, you know what? Of course, the fear is a big one. Lowest volume of sales since 2010, very few sales. Okay, is that going to kick up suddenly? Don't think so. So look for that. And so the median home price did go down. I think it was just by like 5,000. It was like at 430 and change, and it went down to 425. Okay, not a big change, but again, not a lot of properties moving. So, the buyers aren't out there in droves, really kicking sellers, down and trying to negotiate as much. We did go down as predicted. I'd have to look back and see what I said, but I thought maybe 5,000 to 10,000 or something like that, probably. Our price is going to continue to go down and the median price go down in the single family residence? Yes. The answer is unequivocally yes. The question is how much. I'm going to go with another 5 to 10, maybe a little chunkier movement this time, but we're basically in similar circumstances as we were in December. Not going to be a ton of buyer activity in January, maybe a little bit more. So I don't really see that trend changing much. Some details that are going to get us into why, we don't want to deal in hope-ium, folks, and whether or not some of this good news is hope that we can count on and reason for optimism, or if we're dealing in hope-ium because everyone wants hope. I'm going to tell you a story that I think is important and for you to know about the contradictions that people are going through right now. But first, I'm going to tell you about some details. The PPI report, that came out, the Producer Price Index, and it slowed to 6.2% for the year ending in December, lower than expected. This is good news because that's what the Fed wants to see, that they're pushing those prices down, that we're getting a handle on inflation. Year over year inflation rate down, a little lower than expected. That is good news. Inflation is likely to have peaked. But does that mean we're done? No, because we got some problems ahead. And that's where, I don't want to get too caught up in the hope side of things, even though I literally did for a short period of time there. And this is why I delay my Robnostications sometimes, because I'm not really feeling the full information cycle that I need, if you will. So these are indicators here. Consumer price index down 6.5 to 6.5%. The Fed wants 2%. Okay, so that's where we have to understand they still feel like they have work to do, even though they're indicating they're gonna maybe take a little pivot and slow down on these interest rate movements. Here's one of the issues though. The labor market appears strong, but is showing some signs of weakening. But wage growth is an issue here, not keeping up with inflation. We have an issue with wage growth. Basically, inflation is at 6.5%, and wage growth is at 4.6%. So it's still not keeping up with inflation. And unemployment is still at 3.5%. This matters because this is what the Fed is looking at and what they are trying to sort of, they want to tamp down. The labor market is going to slow. Same for wage growth. We're going to see that trend continue. And this is where I start to get a little concerned about the bigger picture, the longer term. Even though we're seeing some good signs potentially of a Fed pivot and things like that, people think that this market's just going to turn around on a dime as soon as the Fed starts lowering rates. So right now they might do little smaller rate movements. Everybody's going to go, great, we're turning around, even though I'm being told here and I'm seeing signs that they're going to hold these higher rates for a longer period of time. These are the reasons why we have to be concerned ahead, because even if they drop the rates, here's what we have ahead. Labor market gonna slow, same for wage growth. This is a problem when you have people being, not able to afford a property or get in to buy property. Over 1 million Americans will lose jobs this year. This is all because of a recession that is happening in 2023. There's no doubt we are in a recession. I think that anyone that's shining that on is shining it on. That's all they're doing. And it's a matter of how much worse it's going to get. The Hope-ium that I'm hearing out there is that, this is going to be a mild recession and that we can just kind of get through this, get on the other side of it, rates go down, everybody's happy again, starts buying houses again. Okay, so here's what the not good news is for the economy. Oil prices are starting to go back up. Shale growth is stalling. Shale is where they also are getting oil in this country, and that is stalling. So we're in this issue. I know that they're taking some of the restrictions off of being able to get oil in this country, but it's going to take time for that to have effect. And first, I think, are all these negative effects. Oil demand is going to rise. So we're going to see higher prices. Oil is a big, big deal. It runs our economy in a lot of ways. China's demand on oil is looking to increase, and maybe quite exponentially, because they're coming out of COVID lockdowns and everything like that. This is, 2 billion people, I think, right? 2 billion plus. It's a lot of oil that's going to start, being needed over there. Look out for high gas prices, what I'm saying. So this type of a thing could extend the duration that the Fed feels the interest rates need to be high. The other thing is, I think people's reliance on credit is starting to ramp up. And that could be an issue, certainly for some of those people that might want to get out and buy a home. If they're, people are starting to lose their jobs, they're more reliant on credit because prices, still aren't great because gas is going high. Fear in the debt markets. After my friend told me a little bit about, reminded me about that fear thing, I went and looked around and what's this mean? The Fed is buying less bonds. This is it's quantitative tightening instead of quantitative easing. I'm not going to get it too much into that, but we had quantitative easing after the last big Great Recession for many years. And now we're looking at quantitative tightening. And the bond markets are probably set to go down as yields rise. And that means rates go up. So if they hold them and we have these other issues, rates may be going up and staying there for a while. And then even when they go down, will people be able to take advantage of the rate movements? Look, I want to get back to healthy, and that's what I'm going to go into the next. If the economy worsens for people to take advantage of lowered rates, That will limit buyer activity. But in the background, rent rates may be easing, and this could also be slowly reducing motivation for prospective buyers, those first-time home buyers, to buy a home, or really anyone that may be considering now, oh yeah, they've wanted to do this because rent rates are such a huge motivation if they're high. But if they start easing, which I think they are going to start easing, we've already seen it where they're not going up anymore. Now it's a matter of if they will settle a little bit more. I think they will. They're not going to get super cheap, but maybe cheap enough to make people sort of go, this sounds like not a great time, and I'll just rent. These things tell me that I don't see any kind of buying firestorm ahead in the future anytime soon. I do see, if the Fed does not overcook things, we may get back to a healthy real estate market. So I'm talking about all these bad things, but in the end, what they are hopefully looking for, if I can put a little faith in the Fed, is a healthy market, real estate in particular. That's what I think is important. Keep in mind that no matter who you listen to, about the markets, these are all opinions, and of course, this is just my opinion on what I'm seeing. The Las Vegas real estate market is not fully known to anyone, but I do think long-term Las Vegas looks fabulous. Okay, so quick story. This is a long one, folks. Quick story. I was in a class last week, and long story short, I mentioned sellers are losing money every day. I mentioned this because it was there was something that was asked about. Well, I was in a class about divorce. When people are going through a divorce, what's your number one thing? Well, you want to be able to tell them what their property's worth, and that, hey, you really want to get that property on the market for the right price, because I believe, and this is my thing right now, that you're losing money every day. And I heard almost a gasp from the class, from the room. Now, keep in mind, this is a room full of real estate agents, and the instructor as well kind of reacted like, whoa, this is where the Hope-ium is in my mind, because I was shocked, as they may have been shocked that I would say this. The gasp wasn't like, but it was like really slight, like, ooh, what are you saying, Rob? If you're not telling your clients this, I think you're doing them a disservice. If you're saying on the other side of things, there's going to be this sweet land of, fields of strawberries or something, and unicorns, I think it's a little much to say that. I think that's more risky than telling somebody right now, here's the actual right now circumstances. The instructor went on to tell a story about how the market could bubble again when rates drop, that everybody's going to get involved and the market's going to bubble again. I think I just went through some reasons why that may not take place, but she said this. And then once rates go up, simultaneously, she was mentioning this story about, she mentioned Wells Fargo getting out of the mortgage business and how that's going to cause havoc on the housing market. And we're going to start seeing short sales and foreclosures coming back. Obviously, I'm just quickly, summarizing what she said here, but I find that to be a big time contradiction. As I heard her speak more, and by the time at the end of the class, she was mentioning that we clearly have a declining market. So it was a weird thing to go through. Everybody knows it's a declining market, but a lot of people feel like on the other side of this declining market is going to be the land of hope and, dreams, and we're going to get back to big time jumps in the real estate market, and we're going to go back up. I mean, at some point, I do believe that, but I don't think this is going to be a quick cycle here. This is going to take some time. The idea is ultimately to get back to healthy, not back to a bubble. So lastly, I just want to say there are too many real estate agents in this market, and they're going to start dropping like flies. I think this is why you see that Hope-ium right now, because they're hoping that they can make a paycheck ahead, and the information they're getting is correct, that things will start to pick back up. We hit a high for real estate agents in 2022. We have so many out there right now, and so many that aren't going to make a paycheck because I'm telling you that the volume is extremely low. That means that there is far less paychecks for people to be in the business. I started in 2009, and I'm going to be here for the long haul. As a matter of fact, the word haul has H-A-U in it, and that means my last name. That's H-A-U, right? Well, once again, folks, I'm Rob Hau, and I'm all about houses and you. So when you need me, get at me anytime. I appreciate you watching this whole video, and I've got many more to come. I hope this helps you make your decisions in 2023 and take advantage of any opportunities that you see. Have a great day.